Hello, I'm Elliot Hirschman. Welcome to another chapter in our series of 6-minute seminars. Today's topic is how to choose a business entity. Be sure to watch all the way to the end, as I'll show you how to avoid a trap the IRS has set for the unwary taxpayer. The choice of business entity is a complex one that involves the needs of the owner and the needs of the business. In general, there are two basic types of business entities. Taxable entities pay taxes on their income. Examples include the sole proprietor and the C corporation. In contrast, a conduit entity's income is not taxable. The income flows through to the tax returns of its owners. Examples include partnerships and S corporations. Let's discuss each entity type. In a general partnership, all of the partners are liable for the partnership's debt. In a limited partnership, one or more general partners are responsible for the ongoing operations of the business. Limited partners are only investors and do not participate in management. Only the general partners are fully liable for the debts of the partnership. In exchange for giving up the right to direct partnership activities, the limited partner's liability for partnership debts is limited to what that partner has invested in the partnership. A limited liability partnership, LLP, or limited liability company, LLC, combines the flow-through characteristics of the partnership with the limited liability of the corporation. In an LLP, a partner can be held personally liable for claims arising from malpractice by the partner. In a limited liability company, no partner is personally liable for the debts of the partnership. An LLC may elect to be classified for tax purposes either as a partnership or as a corporation. A single-member LLC is taxed as a sole proprietorship. Unlike a limited partnership, a member of an LLC can participate in day-to-day management without losing limited liability. Not all states with LLC statutes permit professional service providers to organize as LLCs. For those states, a preferable alternative may be to elect S corporation status. In general, partnerships and LLCs have a great deal of flexibility in the number and type of members, special allocations, and tax matters. On the other hand, partners will owe tax on income regardless of whether it is distributed. Transfer of a partnership interest may result in unfavorable tax treatment, and partners may be subject to self-employment tax. A C corporation is a separate legal and taxable entity that is created under state law. Multiple classes of stock are permitted, and C corps receive favorable tax treatment on certain types of transactions. But they also receive unfavorable tax treatment for other transactions. For example, the accrual method of accounting may be required and may result in a tax on income that has not yet been received. And if the corporation pays dividends to its owners, these amounts are also subject to taxation at the individual shareholder level. This is the primary disadvantage of a corporation. The same amount of income is taxed twice, the double taxation dilemma. An S corporation, or S corp, is created under state law in the same manner as a C corporation. A corporation qualifies as an S corp if a valid election is filed with the IRS. This election must be made on or before March 15th of the year for which it is effective. An S corporation is a special status corporation for tax purposes. It is treated as a partnership for federal tax purposes, thus avoiding the double taxation problem of a C corporation. But since the entity is a corporation in all other respects, the entity provides limited liability to the owner. The income passed through from an S corp to a shareholder is not treated as self-employment income, so the shareholder can avoid self-employment tax. There is a catch, however. The IRS requires that the S corp pay reasonable compensation for services rendered. Otherwise, the IRS may treat a portion of the distribution as wages and will impose self-employment taxes. The Internal Revenue Code specifies a number of requirements for electing S corp status, including there may be no more than 100 shareholders, there may be only one class of outstanding stock, and S status must be elected by all shareholders to be valid. Also consider other limitations of the S corp. Shareholders may not be non-residents, corps, or partnerships. Excess passive investment income may be subject to tax. Shareholders don't get tax basis for loans with third-party lenders, and certain cities, including New York City, do not recognize S corps. Next, let's discuss personal service corporations. Because of the differences between individual and corporate tax rates, certain taxpayers may be tempted to incorporate. To stop this tax minimization scheme, the IRS requires personal service corporations to pay tax at the highest corporate marginal tax rate, currently 35%, on every dollar of corporate taxable income. A taxpayer is a personal service corporation if it meets all of the following tests. It must be a C Corp. Its principal activity must be the performance of personal services. This includes physicians, attorneys, architects, and accountants. These services are performed by employee owners, and more than 10% of the stock must be owned by employee owners. Thank you for your interest. If you have any questions or comments, give me a call.